what we now call the closing disclosure and take the group through sort of a line by line, the same way that I would explain it to a buyer before they go to closing. So just so you know, everyone on the team, when prior to closing, we do a phone call or a Zoom call with the client, meaning the buyer, and we do this, right, and we take them through what's called the CD, and we go over all the numbers, make sure that we answer all their questions up front, that they know how much to wire, that they know what their payments are, and then that way when they get to closing, assuming that you all are going to the closings with them, likely they shouldn't have very many questions after that, because we try to really do our due diligence before closing to make sure that they're really comfortable with what that all looks like, okay? So, anybody have any questions before I get started here?
I have a question.
General question? Yeah, sure.
So is the difference between, this looks like a loan disclosure and the closing disclosure two separate things?
So good question. There's a few sets of disclosures that go out during the loan transaction, okay? In the very beginning, once you all send to us the executed contract, that's when we prepare what's called an estimate or the initial loan disclosures, okay?
Is that still called a good faith estimate? Or that's really old school, isn't it?
Yeah, that's old vernacular, as they say. It's called the initial loan disclosure. Sorry, it's called the loan estimate, the LE.
And the loan estimate is given to the buyer.
Correct. So once we get that executed contract, that's when we send our initial loan disclosures. In that is the loan estimate, right? It's about 25 or 30 pages, depending on what loan they pick. But that's when they sign what's called their initial documents, right? Or their initial loan disclosures. And those are estimates. Okay. What's different is, yeah.
Mike, it's Courtney. Is that when their rate is locked?
It can be, yeah. When we get the executed contract, as part of the initial loan disclosures that we send, they have the option of locking their loan at that time. Okay, typically that's when we lock, right? There could be some extenuating circumstances of why someone wouldn't lock. For instance, I'm working on a new construction deal right now, and we have like this unknown timeline of exactly when the builder is going to be done with the construction. And what you want to be careful of is locking too soon, because if you get to the end of that lock, it costs money to continue to extend or to renew the lock. So in order to sort of do what's in the best interest of that client, typically we'll float those loans just until we get some more certainty from the builder, in this example, of when the house is going to be completed. Okay,
hey Mike, how long is the lock for before it costs more money to extend it? Is it 30 days usually?
So a typical lock time is 30 days, right? And you have a 15-day lock, a 30, 45, a 60. Now, what's important to know here is that the longer the rate lock term, okay, the worse the terms for the client, right? Because if you think about it, right, as the lender, we're essentially tying up those funds. In this case, let's say it's a 60-day lock. So we're essentially tying up those funds for 60 days, right? And we are saying, okay, we're going to commit to these terms regardless of what the market does, right? So if rates skyrocket over 60 days after this loan's locked, right, we're still committing to the lower rate. Do you see what I'm saying? So there's some risk there the longer you lock. So we always try to get people to lock in a 30-day timeline, if possible, maybe 45, because it's a healthy balance of getting them the best lock terms and also making sure that we have enough time between when we lock to when you to when you go to closing. So to answer your question, Anastasia, the lock has to be good through the closing date. Okay. If let's say you lock for 30 days and you get to day 30 and the loan's not ready to be closed yet, or the seller's not ready or something, that's when you have to start getting into extension costs or to relock costs. And it can be expensive. It's 3 basis points a day to extend a lock. Well, what that equates to in real numbers to a buyer is, let's say it's a $300,000 loan. That's $90 a day to extend the lock, a day. So if you need a 2-week extension, you can do the math. That gets expensive fast. So for us, we try to make sure that we're locking with plenty of time on that lock. So God forbid if we lose a couple days for some reason, if we don't close on time, or if the seller's delayed, or there's an inspection delay or something, we got a little bit of time left on the lock because we don't want to get into an extension.
Yeah, the minimum extension is 5 days, right, Mike?
Yeah, so extensions are 5 day allocations. So even if you only need to extend it, 1 day, you got to do a 5-day extension. So it's like I said, it's not cheap. We don't run into that very often, but that is how that works. Any other thoughts on locks, or when you lock, or what that looks like? Okay. All right. Well, this is a loan that's actually closing right now. So I thought this was, apropos. This is at the top of the closing disclosure, it shows your sales price. Okay, and this is showing draft, even though this is a final one. I'm just using this as an example here for the group. So borrower happens to be putting a nice chunk of money down. So the sales price is $380, but the loan amount's only $190,000. Okay. Borrower chose an interest rate of 2.875 for 30-year fixed. I'll get to that in just a second. And that gives them a monthly principal and interest of $788.30. All right. Now there's no prepayment penalty. Does anybody know what that means on the real estate side?
If they pay it off sooner, they don't pay a penalty.
Correct. So almost none of our loans have any prepayment penalties, which just means that, if the buyer hits the lottery next week and they want to pay off this loan in full, there's no penalty to do so. Okay. Of course, if they hit the lottery, they probably don't care about the penalty. But anyway, I think you get my point. There's no balloon payment. Does anybody know what that means? Anybody want to take a stab at that one?
Got like a second mortgage or something?
So a balloon payment, and this was popular, in the early 2000s, in the subprime mortgage days. You would see a lot more of this. But what a balloon payment means is that, so right now, in this instance, in every single loan that we do, or at least most of them, buyer does a 30-year mortgage, and the loan, if they make all their payments in 30 years, that loan is paid off in 30 years, and they have no mortgage left. Okay. What a balloon payment is, and again, you're probably not going to see this these days, but there was a thing where you would essentially, the buyer would have their payments amortized, meaning spread out over 30 years, but the note was due in 15 years, as an example, which was called a balloon payment. So the buyer in this, example, even though they had the luxury of having low payments because they were spread out over 30 years, the buyer would have to bring the full balance of the whole note due in 15 years, which is wouldn't happen very often. So the buyer would either have to sell or refinance or something. So again, it's that's a risky thing for a buyer. So obviously we don't do those, and those are very unpopular now. So as you scroll down here on page 1, it gives an example. So it tells the exact numbers of what the payments are going to be. Okay. So this is something I want to go through because this is I get a lot of questions about this. So the principal and interest, as I showed you above, is $780.30, right? Now, because the buyer is doing a large down payment, they don't have any mortgage insurance. Does anyone want to tell me when typically mortgage insurance is going to be required?
Isn't one of the loan, it's like 80% or less?
That's correct. So when, thank you. Who was that?
Jonathan.
Thanks, Jonathan. So yeah, so if the buyer puts less than 20% down, in most cases, they are obligated to pay mortgage insurance. Okay. Obviously, in this case, the buyer put a huge down payment down, so they do not have any mortgage insurance. And then the escrow is their insurance and taxes, right? So 283.33 made up their total, their property taxes and their homeowner's insurance. And so their total monthly payment in this situation, in this loan, is $1,071.63. Okay. And as you can see, it totals this up here. And it says yes, meaning that these are escrowed and these are included in the payment. Okay. Now, what you may see is this other box may be checked, and this would be for the HOA. So what you may see is other checked, and then it would say HOA here. In escrow, it would say no. And so what you would notice is this total amount would be larger than this, and the difference would be what the HOA is. And what that is indicating is that there is an HOA, so it's an obligation of the buyer, but it's not included in the mortgage payments. They pay that separately, right? Any questions on that? Didn't have an example of an HOA this time, but hopefully you guys get that. So, okay, so then at the bottom of page 1, this is a summary of closing costs. Now, what's a little deceptive about this closing cost field, and I talk to I get questioned on this all the time. This total closing cost figure on the closing disclosure, this is all the closing costs for all the parties. So this is for the seller and for the buyer. Okay, so sometimes the buyer looks at this and says, geez, I'm paying $10,554. Well, that's not necessarily the case. If you read the fine print here, some of this has to do with, other costs, which I'll get to on the next page here, okay? And then lastly, this is the amount here that the buyer has to wire to the closing table. So for those of you, I get this, a lot as well. Hey, how much does the buyer have to wire for the final wire? It's always going to be at the bottom of page 1 on the closing disclosure, and it's going to read cash to close. So in this case, the buyer wired $195,841.69. This buyer happened to have a real nice family trust.
Hey, Mike.
Yeah.
Quick thing. You mentioned that the closing costs includes the costs for the buyers and sellers, but the cash to close is only for the buyers, right? It's not including the seller's portion, correct?
Correct.
Yeah.
Yep. Any thoughts or questions on that so far before I go to page 2?
And obviously, if they put money in as an earnest deposit from the beginning of the contract, the cash to close would reflect that, correct?
That's right.
Okay.
And so this page 1 is just a summary, and then page 2 and 3 is the breakdown of all those numbers, which is what we'll get to next. But you are correct on that. Was that Howard?
Quick question, Anastasia, with the insurance on the loan, if it's an FHA loan, side note, is the insurance for the life of the loan, regardless of how much they put down?
Mortgage insurance, is that what you're asking?
Correct. Yeah, sorry, mortgage insurance, yeah.
Yeah, so we talked about this in the training that I did down there when we went through the loan programs, which you missed, Anastasia, you slacker. But I'm kidding. But yes, you are correct. So on an FHA loan, regardless of down payments, the mortgage insurance is for the life of the loan. Okay, the only way to get out of it is to sell the property or to do a refinance.
Thanks.
Conventional is different. Conventional, if you put 20% down, you don't have it. If you start with mortgage insurance, once you get to, in this case, 78% during the time in which you have your loan, you have the ability to remove the mortgage insurance from your payment.
So let me ask you this.
So
So if they do FHA, like you said, regardless, they're going to have the mortgage insurance. If they happen to put a bigger down payment, does that mean that the mortgage insurance is lowered?
No.
It's still a set amount, a set percentage?
Yeah, wow. It's assuming a 30-year fixed mortgage on an FHA. The factor is 0.85, meaning for every $100,000 in loan amount, it's $85 a month. Just to use easy math. If they put 5% or more down on an FHA loan, it gets lowered to 0.8. So it's really, really nominal. Okay. And that's the lowest it goes on a 30-year fixed. It's a little different on a 15, but you very rarely see a 15-year fixed on an FHA loan. I don't think I've ever done one in my life. Okay, does that make sense? Whereas, and by the way, on an FHA loan, the mortgage insurance is fixed numbers, right? It's the 0.85 and the 0.8. On a conventional loan, it's based on credit score, down payment, debt to income ratio. So there's a lot of different factors on how that mortgage insurance rate is determined. Okay. Yanni, did I answer your question too? I think you were going to ask something as well.
No, yeah, we're good. Actually, no, we're not. So I guess my question was going to be, you mentioned when somebody's already financing a conventional loan, as soon as it gets to 78%, I guess the loan to value or whatever, then the mortgage insurance gets dropped, or the private mortgage insurance, PMI. But if you take out a new loan at 80%, then you don't have private mortgage insurance, right?
Yeah, so let me
essentially, if you're already financing, you have to wait to the 78% mark. But if you just do it from the beginning, it's 80%.
That's right. So if you do it from the beginning and you put 20% down or more, you have no mortgage insurance at all. Okay. If you start out your loan with mortgage insurance, like let's just say you put a 5% down payment down. Okay. You and your loan has PMI, okay, mortgage insurance. There's two ways to get rid of it. If you pay the loan balance down to 78%, then the mortgage insurance or then the mortgage servicer has to automatically remove your mortgage insurance. Okay.
Okay, and what's typically the percentage per $100,000 on conventional compared to the FHA?
it's
Just out of curiosity, I know FHA said it's like 0.85. Is conventional typically a little bit higher or lower?
it's an impossible question, unfortunately, to answer, because it's based on so many factors: down payment, debt to income ratio, credit score. It could, often it's lower because you typically approve conventional loans for buyers who have better credit.
Okay.
But you don't. It could be anywhere from, oh my God, I mean, it could be way higher. It could be way lower. It's a tough question to answer because it's really subjective. But very often it's lower because typically they have better credit. But let me just get back to my other point, just so I don't lose that. So if the buyer pays down their loan balance to 78%, the mortgage servicer has to remove it automatically. Okay. However, if the buyer gets to 78% loan to value based on a combination of gaining equity over time and paying down the balance, the servicer is going to require the buyer to get an appraisal to document that they're actually at 78% or less. Okay, does that make sense?
Okay, so I have a question on that, just to make sure I understand. So due to obviously equity at this point in time, you're telling me that if I went ahead and got an appraisal and realized that I'm now at below 78% because my property is valued higher than it was 3 years ago, I could submit that to the lender or the person currently handling my loan payments, and they would have to remove as long as it's 78% or below?
So they have to remove it if you pay the balance down to 78%.
Okay.
They can remove it if you can document the equity and that you are now at 78% or less.
Interesting.
And
So
very
they
often
can, meaning they might not, right? So even if I show them proof, let's say it appraises for, I don't know, 50,000 more than it did 3 years ago, and I provide this to them, which is going to show proof that, hey, because it's appraising for much higher, I'm obviously at below the 78% cap, then they can choose to remove it, is what you're
No,
basically saying?
no, if that appraisal came in at 78% or less, they would then have to remove it. The reason I said can is because it's a little, each servicer handles it a little bit differently about how they go about obtaining that appraisal. So very
Gotcha.
often they would want you to use like one of their appraisers or a BPO that they do, right? Or some sort of mechanics like that. They probably won't just let you go out and use your friend to go do an appraisal for fear that it could be manipulated.
Gotcha.
Okay, so we're recommending
this.
that if a homeowner wants to go that route, they should reach out to their loan servicer first to get the steps to get that done.
That's
correct?
exactly right.
Okay.
Exactly right. And each servicer handles it a little bit differently, but that's typically what they'll say is, okay, we can either order a BPO, which is a broker price option, which you probably heard that term, and that's just sort of like an automated desktop type version of an appraisal. It's less cost. Or they'll say you can order a full appraisal and it's a higher cost, but then they actually send somebody out to the property and take photos and blah, 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 blah. Okay. And that would be done directly through the servicer that you're making the payments to. Okay. All right, moving on. So closing cost details. So let's talk about this. So on the first page, that was the sort of high level version. And then here, this is what you would call, I would call the broken down or the granular version here. So let me take you through this. So first of all, in the first box here, okay, and we'll call this, and this is called box A. Okay, this is any what we call lender fee or loan discount or lock rate costs. Okay. So in this example, the buyer chose to pay a small premium to get a lower interest rate. Okay. So they, at the time they locked, now this was, I don't know when we locked this one. This is probably a month ago. At the time they locked, to get a 2.875 rate, it had a cost of 0.561% of the loan amount, okay, which equated to 1,065. So the buyer elected to pay a nominal cost here to get a lower interest rate, and they went ahead and locked in that rate at 2.875. Okay, so this is at the buyer's discretion, meaning, you know, when we talk about locking in interest rates, they can either they either have a rate that doesn't cost any money, then they can do a lower rate which has a cost. We give them examples of what those costs are, and it's all based on the market at the time, down payment, credit score, loan program, etc. They can go higher on rate and they could get a credit back. All right. So in this case, the buyer elected to do this, and they locked in the low interest rate in the 2s for 30 years. And then these are the fees that we charge as a lender, processing and underwriting fee. But by the way, these are the only fees that we charge to the buyer, period, end of story. We do not have any other costs that go to the buyer at all. Okay. This is what you would call lender costs. Now, one other thing to note, if you have a VA client, we do discounted costs for veterans, and these costs, instead of being this is $13.99, it goes down to $6.95 or $6.99 or something like that. So we give a break to our veterans. Those are the only costs, period.
I have a question, Mike. When it comes to those costs, like how do they vary? I know like certain lenders and brokers, those costs, like I think are like usually 2% or so. I'm not asking because whenever we review these for our clients that are in with different lenders, we just always want to make sure that our clients aren't being taken advantage of. And especially when it comes to like doing a bank statement loan, are those costs also higher as well too?
Yeah, they're much higher on a bank statement loan or one of these investor cash flow programs or something like this, where you do like alternative documentation or no documentation. You know, of course, there's more risk in those, and so certainly there's some more costs involved in them. And we do very few of those, but you know, in the instance when the buyer needs to do them and we don't have any other options, then yeah, then we'll go to that. But you know, 99 out of 100 transactions are your typical conventional FHA VA loans. So this happens to be a conventional loan, and this is what the cost would be on a typical conventional loan. And to answer your question, it's not a percentage of the loan amount. These are fixed costs. Okay.
Mike, aren't these charges go up for FHA? Is that correct? Isn't it $15.99 for our fees and FHA specifically?
Correct. This is a conventional loan, so they're $13.99 here.
Right.
Okay. Any questions on that?
All right, I have a question.
Yeah, sure.
So these fees are issued by the mortgage company, correct? Like a flat fee?
Correct.
So why is it that Kyle just mentioned that for FHA, the fees are higher? What is it about an FHA loan that makes you guys, I guess, charge a higher settling fee? Is it just a harder loan to process, or, I mean, what's the reason why it's higher then?
Yeah, there's a heck of a lot more paperwork, that's for sure. So that's probably what plays into that. I don't make those decisions, but that is what plays into that.
And these fees are standard, meaning there's no way possible that a person could negotiate these fees down, I'm assuming?
Well, for instance, like, you know, very often we'll do a lender credit, right? Depending on what rate they choose. And they could get a credit back for some or all or even more of this. I just did a loan transaction, just locked in a loan last, I guess 2 weeks ago now. And the buyer had like $4,200 in lender credits. So, it just, all depends on, what they decide to do and, what's important to them, whether they want to really maximize or minimize their cost out of pocket, right? That they go to closing with, or
Mike,
if
can
they
you
really
explain what a
want to.
lender credit is? So a lender credit is just when you guys choose, right? I mean, isn't that, because I think Yanni's asking if it's negotiable. You see what I'm saying?
So the lender credit is based on what rate they choose. Okay. So let's say in this instance, and I'm using some kind of like some arbitrary numbers here. But in this case, the buyer chose a 2.875 rate, and that had a cost to it here, the 0.561. 3% would probably have no cost. 3.125 would have a credit back to them, and that would probably be somewhere in the same range here, this 1,065 or somewhere in that range, right? So in that case, the buyer might say, hey, listen, I'd rather, maybe I'm tight on cash, or I don't have a lot of money to bring to closing. I'm gonna elect to have a little bit higher interest rate, and I'm gonna take that lender credit and I'm gonna use that to offset some of the costs of money I have to bring to closing.
Interesting. Yeah, I didn't even know how that kind of worked. So that's good to know.
Yeah. And like so example, like that buyer that I was telling you about, they elected to have a higher interest rate and get a lot of credit back because they basically said, hey, Mike, like we're probably only going to have this house for like a year or two. So we're less concerned about the rate, right? Because, rates are still really low. So it's a negligible difference in the payments. And they're like, geez, we'd much rather bring less money to closing. Okay. So for them, that made sense to do. So.
Wait, did everyone just get disconnected, or was that just me? You guys are all still here?
Yeah, we're all still here.
Okay, cool. I was worried that because I thought maybe I was the host, but I'm glad that I didn't disrupt.
Yep. We can hear everybody. Okay, so as we move on here, section B, these are third-party costs, right? So these are the actual costs that that the buyer incurs for third-party fees, meaning appraisal costs, credit verification, employment verification, tax service verification. All of these are verifications that are required by either Fannie Mae, Freddie Mac, or Ginnie Mae to get the loan approved. And these are the actual costs that we incur and pass them on to the buyer. Okay, so the appraisal fee, as you can see, was paid for up front. So we moved that to what's called a POC, which is a paid outside of closing. So we took that out of the total dollars that the buyer has to bring to closing. And then these are the actual costs that we incurred to verify those items on the buyer's behalf. Okay. Any questions on that? That one's pretty straightforward. Section C, these are the mainly the title costs here, okay? So what you're gonna see is, now in most situations, as we know, the seller chooses the title company, at least in most cases. And so these are the costs that come from the title company. And these are the actual costs for the title insurance, survey, the recording, etc. Okay, so you got your survey here, you got your recording fee, your lender's title insurance, the settlement fee, which is charged by the title company, and then your search and your endorsement fee. Now, some of these are in the seller's column here, but the majority of these are buyer costs.
So I just want to point something out to my team that the settlement fee actually is negotiable, and something that I would definitely pay attention to. I've seen other title companies try and jack that number up to like $895 for unknowing buyers. So depending on who you represent, and actually, Mike, I think most of, like in Broward County here, the buyer chooses title. In Palm Beach County, the seller does.
Yeah, Broward they do, right?
Sorry?
You're right, in Broward, that's right.
Yeah, right. So I thought it was most counties, the buyer chooses title. I understand. I mean, it makes sense.
It's-
If the buyer's the one paying for the policy, they should be the one choosing, right?
Yeah, it's actually the opposite. In most counties, the seller chooses. But in Broward for sure, and I think it's Dade.
I know Broward, Miami-Dade, and St. Lucie, the buyer that chooses. In Palm Beach County, seller. But either way, I want everyone to understand that the settlement fee is something that you should look at. You can often save your client a couple $100 just by asking. All you gotta do is say, "Hey, that settlement fee is high," and they'll reduce it. So that's something to keep in mind. I also wanted to see, while we're on this talking about insurance, I want you to, I mean, if it's okay, Mike, if you want to explain quickly to everybody, I don't know that they get like the different types of title policies, because I know that there are, there's the owner policy, the title policy, the lender's policy. And I think that's an important, because when we talk about who's paying for title, I want people to understand we're talking about the owner's policy. We're not talking about the lender's policy.
Yeah. So there's two title policies. Okay. There's a lender policy which protects the lender, and then there's a buyer's policy or an owner's policy which protects the buyer. Okay. So in this instance, and in most cases, the lender title policy is paid for by the buyer, and the owner's title policy is paid for by the seller. Okay. Now, why are there different title policies? Again, they protect different parties. All right. And what it essentially does is it protects each party from, liens or clouds on title that could pop up after they own the property from things that happened prior to them owning that property. So if the buyer owns the property as of today, in this instance, this buyer will, if tomorrow there's a mechanics lien that gets put on title from some work that was done by the prior owner last year, well, neither the lender or the buyer have to pay it, right? It's protected by the title insurance.
I think the other part that's a little bit confusing is that it's called the owner's policy. And so the owner policy refers to the new owner, the person that's buying, and not the current owner. And so sometimes that can be a little bit confusing, but I think it's important. And if there is no loan, there's obviously no lender policy. The lender
That's
protects
right.
the lender, the owner's policy protects the buyer if you're representing the buyer.
That's right. If you have a cash transaction, you do not have a lender policy, right?
And often, actually, something else that I want to point out when it comes to the settlement fee is that, again, if it's a cash transaction, you can usually request that they lower that, because it's a lot less work on a title company. There's not as many, they're not prorating, or I mean, they are prorating, but they're not doing all this jazz that we're talking about now because there's no lender.
Right.
Okay, I'll stop now.
You're okay. Thank you. Thank you, Joanna. Okay, any questions on this?
Yes, it's Katya. Can you hear me?
Yes.
Yeah, can you clarify again the owner's title insurance when the unit is completely paid for and the seller is being invoiced for that title insurance? What does it mean?
I think I understood what you said. Did you say what happens with owner's title insurance if it's like a cash transaction?
Yeah, I just had a closing whereby the buyer who has paid completely for a unit was invoiced for owner's title insurance to the land title insurance company was for. What does that mean?
Well, if it's a cash transaction, the owner's title policy is optional. Okay.
Is that so? I didn't know that. I thought it was required.
It's optional on a cash transaction.
That's optional?
It is. Now, I would strongly
great.
encourage a
Yeah,
buyer
I mean,
to get it.
I would never let somebody buy a property, Katya, without getting it insured from it, because exactly what Mike said, if there's a previous lien or cloud on the title, the new owner is now gonna have to deal with it. Theoretically, they could lose the entire property depending on what the lien is.
That's right.
But I think what you're asking, Katya, if even it's irrelevant whether or not the property is owned outright or not. 'Cause I think
Okay.
that's what you're saying.
Yes.
When somebody's buying a property, once they close on that property, they want to make sure that there's no claims on title. So you don't want like your buyer closing and then somebody calls and says, oh, my great grandfather actually owned this property and this is mine. And then your buyer now has lost it. So it's completely irrelevant. Equity or who owns it previously, that's irrelevant to ensuring that once they close, nobody else has any claim to the property. Does that
So-
answer the question?
Search on your deed does not certify that. You still need insurance. Pay
Title
any-
insurance, yes. Yeah, because like Jordan said, even though you buy the property and you own it outright, that doesn't mean that somebody couldn't make a future claim to the property, right? So that's what
It's
title
an
insurance does.
it's
It protects that.
Oh,
Think about what insurance does, Katya. So even though, yes, you run a title search, it's very possible that something doesn't show up, and that's what the insurance policy protects.
okay. Is it a flat fee or not? No? Okay,
No, it's promulgated.
thank you.
Okay, thank you, Katya. Next section is just the taxes, right? And these are fixed amounts, right? So you got your recording fees, you've got your Florida dock stamps and intangible tax, which is a buyer responsibility, and typically what's called your Florida state deed or your transfer tax. That's typically a seller responsibility, and you'll see it in the seller's column here. Okay, but these are the
So-
same no matter what you do.
Sorry,
Or-
Mike, I want to ask, because I know Katya was just asking about how to calculate the owner's policy. Do you got Katya, that fee as well as the dock stamps are predetermined rates. And it's something that I think we should all have a general understanding of how to calculate it, because it's a little tricky. It's per 100 or whatever that, I always forget the formula. Do you guys use a calculator, Mike, I know whenever I want to figure it out, I just Google and I just quickly type it into like Old Republic or some random title company. What do you guys, is there a way, or do you want to quickly go over those rates so that everyone kind of has a general understanding of what the difference is between dock stamps and the owner's policy?
Well, yeah, so I can tell you the formulas for the taxes. As far as the title insurance, those are sort of auto-populated for us. That might be
Yeah,
better. I don't know.
I'll pull it up while you. I'll get that.
But I can tell you for sure what the taxes are, right? So when a property changes hands in the state of Florida, and in this case, these are the buyer's costs here, right? Which is the Florida dock and the intangible tax. So the Florida dock is 0.35% of the sales price. So again, if it's a $100,000 sales price, it's $350. And the intangible tax is 0.2. So combined, these two line items usually get combined on the same line. It's 0.55 total of your sales price.
Right, and then to answer, I'll answer your question earlier, Katya, about how you come up with that rate. So title insurance, like I said earlier, it's a promulgated rate, which means it's predetermined, and it's calculated as follows: $5.75 per $1,000 up to $100,000, and then an additional $5 per thousand. It's kind of it's a little bit of a funky formula, and it's not like that easy. So if I'm curious about it, I'll just type it into a calculator. Actually, CJ, the attorney and the title company that we work with, they have an app. Can't remember the name. Does anyone remember the name of CJ's app? Palm One. It's called Palm One. And if you have Palm One, you can actually type in the And by the way, the owner's policy, is it the purchase, or the lender's policy is calculated on the loan amount, right? Mike,
Right.
and then the owner's
Correct.
policy is the purchase price. So you type in the purchase price and it will give you the estimate of what that is. And that will help you give your buyer a general understanding of what their closing costs are, because usually that's a pretty large chunk.
Okay, great, thank you.
And then just one last thing I'll just add to that. So this, the state deed tax, or what you would commonly know as the transfer tax, which in most cases is the seller responsibility. That's 0.7% of your sales price. Okay. But again, I'm kind of focusing on the buyer side here, but just so you know. Let's talk about escrow of insurance and taxes, because I get a lot of questions on this. So I think this is a good place to spend some time. So first thing is, and I'm in section F under prepaids here. So in most cases, the buyer escrows their insurance and taxes. What does that mean? Somebody tell me.
It means it's included in their mortgage payment.
Absolutely right. Thank you. So what that means is that their mortgage payment in this instance, right? If I scroll up here, instead of it being $788.30, their mortgage payment's now $1,071, right? Because we're taking into consideration their insurance and taxes, and we're collecting them each month for them. It's being held in an escrow account so that there's enough money set aside to make those payments on their behalf to the insurance company and to the tax authority when they come due at the end of each year. Okay. Now, what's unique about insurance versus taxes is that homeowners insurance gets paid ahead. Okay. So when the buyer closes today, they are obligated to pay a full 1-year policy in advance. In this case, it's $22.49 to the insurance company. So we're collecting the full insurance policy because we're going to pay that part now. Okay. And then down here in section G, we're also collecting a couple of months, and these taxes say 12 months, but then there's a credit down below, which I'll explain. But it actually nets out to a couple of months each of the homeowner's insurance and the property taxes. Now, does anyone know why we collect both a year insurance policy and 3 months for the homeowner's insurance up front? Anybody want to take a stab at that?
Because the prices could go up.
That's one reason. Yeah. So one of the reasons is that, yeah, like, you know, this policy at $22.49 might be $2,400 next year. Well, the mortgage insurer or the lender's not going to chase buyers for $150 all day long, right? That would be a nightmare. You know, that would be an accounting nightmare. So they take a little bit of a cushion. And then the second reason is that, you know, we're closing on 8/11. Well, the buyer doesn't make their first mortgage payment till 10/1, right? So the lender doesn't have a chance to collect any mortgage payments or partial insurance and tax payments, right? Because they're not collecting mortgage payments for another month and a half. So we're setting aside a couple of months here to account for not getting mortgage payments until October, and also possibly a change in policy. Okay, does that make sense? Any questions on that? I usually get a lot of questions on that. Okay. So you're going to see a full year of property taxes are collected. Now, remember, there's going to be prorations down below, which are going to offset this. Because remember, the buyer is only obligated to pay the portion of taxes that they're responsible for from when they owned the house to the end of the year. All right. So while we're collecting a full 12 months, they're going to get a credit down below from January 1st through, you know, 8/11 from the seller. They obviously didn't own it during that time period. That's part of what the aggregate adjustment means. I'll show you that down below here in a second. Okay. And then these are the real estate commissions. Here was the we talked about this earlier. This was the owner's title policy, and you actually see it. It actually reads here optional, as I was mentioning, because if it is a cash deal, it is optional. So they leave that in there. And this is also where you get a transaction fee or any of this kind of stuff from the real estate groups. Okay. Any questions? You guys are used to reading that part, I'm sure. If there was a lender credit, it would show up right here. In this case, the buyer paid a little bit of cost to get a lower rate, so they didn't get a credit. But if they were to get one, that's where that would be. And then something that's interesting here on page 3 is that there's always a comparison of what our original loan estimate was to what the final one was. So we take a bit of pride in that, almost every single time, our original loan estimate had the buyer bring in 197. Well, they only had to bring 195 when we reconciled all the numbers. All right. So buyers always like it when you come in a little bit better. All right. So you can always look at that if you choose to. And then, the last section here is really just the total of everything above, and then some of the credits. And I'll explain that. So as you can see, down here at the bottom under section L, this is where we're going to see the credits, right? So someone mentioned where's the earnest money deposit? Well, that's factored in here. Okay, so there was a $3,000 earnest money deposit, which the buyer put down when they purchased the property. Of course, they're getting a credit for their loan amount, right? Because they're borrowing money here. Here was the seller gave, the seller essentially paid for the owner's title policy, $775. Okay. And then, as I was mentioning earlier, this is the credit as well from the seller, because the seller owned the property from 1/1 to 8/11, meaning through today. So the sellers is responsible for those amount of taxes, and they're giving that back to the buyer as a credit. Okay. Any questions on that?
Yes, do you mention anywhere the estoppel fee? Because I have a question about it.
So if there is an estoppel fee, now this one didn't have an HOA, so there's probably isn't one here. Let's see, yeah, there's no estoppel fee, but it would show. It would show right up here. It would show in section C here.
I have a question on it. There's always a flat fee for an estoppel letter. Is the title company allowed to make money on it? Like if you are charged $250, can you charge, the title company can decide to charge $420, for example?
Yeah, my understanding is no. That might be a better question for Charles.
I'm pretty sure it's no. I'm pretty sure you can't.
I know for us, like on the lending side, we have to pass through the exact third-party costs, as I was mentioning earlier, for like credit report and verification of employment and things like this. And I'm virtually 100% sure that the title company has those same rules, and they can't pack in any profits there. They have to pass on the exact amounts from the third parties. In this case, from.
Are you allowed also? Can you request a copy of all those fees that come from a third party?
Yeah. We get what's called like a pre-CD or an initial CD that the title company sends us once we order title, right? So once we send out, once the buyer signs their initial loan disclosures at the very beginning of this of the transaction, we place our title order, and the title company, and typically it takes them a week or so, they send us back all of our title work, in that title work is also a list of what all those costs are, the third-party costs, or at least most of them. Sometimes they don't have them all back yet, but they always give us their costs and as many third-party costs as they already have. So you could always ask us if you want to, and we could send you what we have, or you could reach out to the title company directly and you could get a copy of that.
Thank you.
Sure. So at the bottom here, this is just, a summary of all the costs and then a summary of all the credits. And that's how you net out to this final number that the buyer has to wire to closing. And this number, again, matches the number above, 195, 840, 169. That's the amount of the final wire. And of course, this is how much the seller gets. But as the purpose of this was kind of to focus on the buyer side, but I can certainly answer as many questions as you want on that side too. All right, well, that's the long and short of it. Now, the last page here is just like informational purposes. It's not really much to go over here. It just explains like what happens if you make a late payment, what happens if you miss your mortgage payment, what happens if you make a partial payment. But that's more for informational purposes. Okay, and then of course the contact information for all the parties involved. Thoughts, questions, commentary?
I have a question. Name is Kyle. Long-time listener, first-time caller. So this has to be out.
I love that, Kyle Ken. I love that.
This has to be out 3 days before closing. Is that right? Or is that the loan disclosure?
Yes. This was the Howard Stern calling here. Yeah. So the initial closing disclosure, and sometimes that could be the same here, right? But the initial closing disclosure has to be given to the buyer and signed by the buyer 3 business days prior to closing. Now, when I say those documents could be different, the initial closing disclosure and the final closing disclosure could be different if, we can't issue a final disclosure until the loan has a final approval. So in some cases, that initial closing disclosure is starting to be created between our closing department and the title company, sometimes a week or even 10 days prior to closing. So if there isn't a final approval yet on the loan, the initial disclosure could be unreconciled, but we still have them sign that because that starts that 3 business day wait period. In this instance, this loan happened to have a final approval, 10 days before the closing. So they were one and the same. So when this disclosure went out to the buyer prior to closing, this one happened to have all the final numbers on it. Does that make sense?
Yeah.
It's a good question, Kyle Kane. Anybody else? Questions, thoughts, feedback? Okay. Well,
thank you, Mike.
You're welcome. My objective was to keep this to an hour, and we're at 10:04, so I've gone over by a few minutes. But I wanted to have enough time to just go over this line by line. You may have other questions. Happy to answer them. You can get with any of us after the call. Certainly, you can call me, but Michelle, Kyle, Ruben, Haley, anybody on our team is more than willing and able to answer these questions. I was the one who happened to be the one who's doing all the commentary here, but all of us are certainly skilled enough to be able to answer these for you. So if you do have questions about individual clients, certainly feel free to reach out to any of us and we can answer them for you, okay?
Good morning, Mike. Thank you so much. This is Max, and thank you everyone for joining. And just a quick question before we leave. What do you guys think the next session with Mike should be about? What is the topic that you want Mr. Mike to talk about next time? You can just either Slack it or you can put it in a chat. It's kind of like a little pool in here. So we make sure that we're always providing you with the trainings that you want. And thank you again, Mike. Thank you, everyone. You can just either put it in the chat or you can just Slack it to me and we'll forward that to Mike. And I hope everyone have a great day.
Well, hold on. Actually, so does anybody have any thoughts on that? Or Mike, is there anything that you think is a good topic as far as scheduling another training that you think you get a lot of questions about?
I'd like to hear from the group. That would probably be the most helpful. Can anyone share any feedback of future trainings that they'd like to hear? Well, I want to put you all on the spot here. If you don't have any, that's okay. You can certainly think about it. And like Max said, put some stuff on Slack and we can create some stuff around it.
Yeah, I'll say something quickly. So the only other thing that I think would be beneficial, and I mean just informative, I guess, is getting more of a full understanding of how to move the credit when necessary. You know, when you come across a person that has, 30 or 40 points below the standard where they need to be, like the steps that you take or the recommendations that you have for these buyers, because I know you guys do like a credit analysis and you can look at the report and kind of move some things around or make some recommendations. Because for example, I was recently going through this and like some other lender at one time told me or told the buyer like, hey, you pay down your credit card to $500, not to a zero balance, because if you pay it to 500, it shows the revolving credit. So it's actually going to help your credit opposed to lowering it. Like, I don't know, it just confused me. So I'd just be curious as to the best practices, what they would be around or evolving around credit to ensure that a person can boost up their score or keep them where it needs to be. I guess that's the only thing I can think of.
That's a great suggestion, Yanni. And let's make that our next training. And what I'll do is I'll share with you all our credit simulation software system, and I'll show you on the screen how we analyze the credit, how we give them tips on maximizing their scores. And, in some cases it's not necessary if they have great credit, but in some cases it is. And so let's make that our next topic, Max and Jordana, because I think that's a great thought. And I'd love to share that with the group.
Awesome. We got a next topic for our next session. Thank you so much. I'll prepare the dates and I'll update everyone.
All right, guys. Thanks. Have a great week.
Thank you so much, Mike. Thank you.
You got it.
Bye.
Take care.